It's an urgent alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's Vanguard's urgent warning to all investors. And what I want to understand, if what Vanguard's suggesting is true, then as you're about to see, it has dire implications for not only the markets, but for the entire U.S. economy. Now let's head over to Bloomberg, where he picked today's story up with a headline. As Vanguard says, Fed's caution will hold back on Canada and rate cuts, and what they're suggesting is there's serious issues with the global economy, specifically the U.S. economy, and as we know, the Fed is in no urgency to cut rates, which means danger is coming and fast, as cuts at every other meeting are more reasonable to expect in Canada, as Governor Tiff Macklem, as Governing Council, quote, may need to get assurances that the Fed will engage in a cut, even if it will come later. And as we know right now, Fed Chair Jerome Powell has absolutely no urgency when it comes to cutting rates because they're hoping to see inflation come down over the next several months, but it's not going to be enough because the economy is headed in the wrong direction. As we look here, as Canada's role as a major commodity exporter leaves it vulnerable to currency volatility, which is something we're seeing throughout major economies, which may factor into the central bank's thinking, even though it doesn't explicitly manage policy for the exchange rate. And the Canadian dollar has sagged this year versus the greenback due to a combination of slower growth and decelerating inflation, not to mention a lack of demand for the currency, which is exactly what starts to happen when economies slow down. But let's take a look at what Vanguard suggests, as inflation should continue its march toward the central bank's 2% target, which means fixed income investors enjoy a real or positive inflation-adjusted yield. And what this should do is start to see flows move into the bond market in a meaningful way. And we can look at the recent U.S. Treasury auctions and see that the 10, 20, and 30-year auctions all saw very strong demand, not to mention China's 50-year bond auction as investors look to get ahead. And it's a good time to be in bonds, Vanguard suggesting. We're saying bonds are back, and this from the chief economist of the Americas and global head of portfolio construction. And if bonds are back and central banks are looking to cut, well, that's not the news that equity investors are hoping for. And this is the problem, because what we're seeing right now is investors are crammed into 5 U.S. stocks. This is something they did at the peak of the dot-com bubble. It's again, they did it at the peak of the global financial crisis. Many said they never do it again, and now they're facing with the same dilemma. And here you can see that yields on the 2-year Treasury security, that investors believe that if yields fall, it's going to create a surge of demand for the economy and set equity prices higher, which is why they're cramming in big ways. And here you can see that if indeed yields start coming down as central banks cut, it usually means there's something really wrong with the economy, and that means equity prices likely to come down in a huge way. But something that is booming, that's the oil market. Take a look at this. This is from our CTA Timer Pro report. Now, this is something that every day we look at the machine positioning and we try to find when machines are deep short and prices are moving against them, because that means machines have to short cover, send prices higher. And just the other day, we noted that they had to buy $30 billion worth of crude. Well, look at this. Back on the 11th, I flagged to our subscribers that when USO triggered, it was a low conviction trade. The next day, I said, well, my conviction yesterday was low. The inventory reports indicated a draw today, and we also get the EI inventory reports. That actually turned out well. And then look what we get today. Crude inventories down, distilled stocks down, gasoline inventories down, your trade up. This has been on the books for 6 days with our subscribers to our CTA Time Pro report. It's up 2.39% as of close of yesterday and going even higher. And here's the best thing. You don't have to be an expert at trading. You just start making money, and you can do that with a 30-day free trial. Link in the description below, because we're going to see lots of opportunities show up. We're going to show you how to make money even in a bear market, as the Swiss National Bank unexpectedly cuts rates again as Swiss inflation continues to ease. So as we look back to the 2-year Treasury yield, if we start to see central bankers cutting, that's going to bring short-term rates down, but it's also going to bring long-term rates down as well. And here you can see the Swiss franc, which had soared in the past 3 weeks after the shocking result from the European Parliament elections hammered the euro, weakened against other currencies, and stocks gained after the central bank cuts policy rates by 25 basis points. Well, guess what? Our subscribers, we alerted them to a trade on, of course, the Swiss currency back in early May. Check it out. Be a subscriber. We are giving you the trades you need to make money. We give you all the details. Even the Bank of England now looking to potentially cut rates. And I wanted to see where the central bankers are at, because as we look toward the U.S. economy, it gets worse as speculation of UK rate cut is coming now this summer. Here we see Governor Andrew Bailey said it was, quote, good news that inflation fell back to its 2% target for the first time in almost 3 years, but that officials wanted to be sure that pressure on prices is subdued before acting. And that's what we continue to hear from these central bankers, is they want to wait. They want to make sure that this time they get it right. The problem is, as you're going to see, economies around the world are starting to falter, and now the U.S. is showing up in the data in a meaningful way. By the time the central bankers figure it out, it'll be too late, because with price pressures cooling and unemployment rising, you get those in tandem, there's more speculation that the bank can step back from a rates policy designed to weigh down on demand. And that's the whole idea here. This is what you see in the equity markets right now, is that investors believe that, man, if the Fed could just cut rates 0.25% or maybe 0.5%, the demand is going to flood to the economy. And yet history shows time and time again it doesn't come out that way. And yet when we look at, of course, the labor market, here you can see 2-year Treasury yields suggesting, if Vanguard is right and that rates are indeed coming down, it's not good for the labor market as well, because you look here against continued unemployment claims that we don't now. We'll talk about what they did this week. As you see yields coming down, unemployment claims headed higher, and people staying on the program even longer. And you see that relationship over and over here again. So this is why Vanguard is warning, if indeed bonds are back, this is not good for the U.S. economy. Now, as we look at, of course, the labor market, U.S. initial jobless claims now lingered near a 10-month high last week and have slowly started moving in an upward direction. As we see, initial claims decreased 5,000 to 238,000 in the week ending June 15, now after reaching a 10-month high. But that's not what we're concerned about. It's continuing claims, because if an economy is healthy, then people get on unemployment, and yes, it might be there for a little while, but they're able to get a job. So when you see continuing claims start to rise, it means people on the system aren't getting a job, and people coming onto the system have little hope of finding one. And here you see the proxy of people receiving unemployment benefits rose to a 7th straight week of 1.82 million as of June 8th, just 1,000 shy of the highest level since the end of 2021. And this is indeed moving in the wrong direction. But here's what the experts say. Well, in the 20 years preceding the pandemic, well, look at the data. Initial claims were around 345,000 and continuing claims were at 2.9 million. So this is nothing, but it is something, because when you come from an overheated economy and you start removing demand in terms of people's spending power, it has an impact on the markets. And one thing we've noted is that where continued claims go, initial claims will indeed follow. Here we're looking at continued claims in red, initial claims in blue. And while initial claims have remained relatively low, you can see that continued claims have not fallen and are now starting to head higher. That means, of course, initial claims likely to move up. And you think about the timing of this. Of course, as we look at the summer months, this should be a time where people are traveling and spending, and there should be a lot of hiring going on. And we're seeing now just the opposite as we turn, of course, to the U.S. manufacturing sector. Again, making the case of why Vanguard's claim that this is a time for bonds has bad implications for the U.S. economy. We turn to the Philly Fed, the Manufacturing Business Outlook survey, as activity in the region was mostly steady overall. The survey's indicator for general activity edged lower but remained positive, while the indices for shipments and new orders remained negative. The employment index increased but remained negative, and yes, both price indices continue to indicate overall price increases, which means, of course, inflation still in the manufacturing sector, but consumers tapped out. And on balance, the firms continue to report a decline in employment. And so this is something we've been warning about. This is something that's just finally starting to show up in the weekly claims. It's not really showing up in the non-farm payroll report, is that employers are starting or continuing to lay people off here. And we see that as the employment index rose 5 points to -2.5, the 8th consecutive negative reading. But there's some good news that manufacturers are finding balances, because the average work week index rose from -8.3 to 4.8. So what you're seeing here is they let some more workers go, and they gave those who are still there a little bit more in terms of hours. The issue here is the fact that people are headed on unemployment, and there's no signs that there's going to be a job for them. And here you can see why, of course, the relationship between the Philly Fed employment index and continued unemployment claims is so strong, because as manufacturers lay off, as you see here in blue, indicated by current employment going negative as it crosses through the horizontal black line, you tend to see periods where continuing claims rise, or at least have a steady increase. And that is an issue, as we see here throughout many intervals in the economy, that as employment continues to drop here, people are going to get on unemployment, they're going to stay on unemployment, and their spending power is going to be zapped in a big way. And yet prices continue to go up, what initially hammered the bond market this morning, but buyers stepped in a big way as firms reported increase in prices overall in June, which has everything to do with the energy sector. Of course, oil headed higher, our subscribers making money, and you too could do that. Links in the description for your 30-day free trial. As current prices paid, you see the relationship here against West Texas Intermediate crude oil in red. You see that very strong relationship. As crude oil prices head higher, it means that factory prices are going to head higher as well. But one thing that we already know is that consumers cannot afford these higher prices. So just because they're showing up in the factory sector doesn't mean they're going to be inflationary. If consumers don't come out and spend, look, of course, for prices at the consumer level to drop. And the new index for new orders, which is evidence that consumers are indeed tapped out and spending less, recorded a second consecutive negative reading, but moved up from -7.9 to -2.2 in June. Of course, we know that this is likely to get worse as new U.S. home construction plunges to the slowest pace since June of 2020. And you know, when a housing market of an economy goes, well, everything else goes with it. And this is dangerous as housing starts decrease 5.5% to 1.28 million annualized last month. Building permits, which point to future construction, fell whopping 3.8% to 1.39 million annual rate, the weakest since June of 2020. The declines in starts and permits were broad across multifamily and single-family units. Authorized permits for single-family homes dropped for a 4th straight month to the slowest pace in a year. And as builders start building fewer homes, well, that means there's going to be less work for people. More people eventually headed to the unemployment line, and that is dangerous news. As the weakest U.S. housing starts since the pandemic-led shutdowns are fairly convincing evidence of restrictive monetary policy. What it means more so is that consumers are out of money. And we've talked about how their savings rates are near rock bottom levels, how their incomes are decelerating because the hours worked were declining broadly and wage increases were shrinking. We noted that more people are on unemployment. Of course, they're not buying homes. When you start putting all that together, it makes perfect sense why people aren't buying homes. Is it due to restrictive policy? Well, it's simple. If the economy was booming, people could afford higher prices and higher rates. They just can't. And while growing population and workforce are providing some support, U.S. home builders won't become busier until borrowing costs fall. Well, that's not exactly true as all. We'll make that case here in a bit why falling rates are not going to be what home builders really want. But as we look at new privately owned housing units started in blue against future new orders, this from the Philly Fed, you can look at the direction of where new orders are going. And the key part here is as new housing starts to decline in blue, what happens is new order demand from the manufacturing sector that declines as well. And as we know, there is a strong link between new orders and existing order books and levels of employment. So while we see some stabilization at the factory level in terms of a number of employees and hours worked, if the housing market continues to slide based on what the builders are doing, then it means, of course, more people likely to lose their job, head to the unemployment line, and it's game over for the U.S. economy. As major home builders, including Lennar and KB Homes, have been trying to offset high rates with generous sales incentives, which has helped boost demand. Even so, the companies have been able to maintain healthy margins. And I love this. They say, which executives say can go up further when lower rate environment allows them to reduce concessions, but they don't understand lower rate environment means we're indeed heading into a recession. And this is the evidence. Because as we look at two-year treasury yields, you can see there are many cases. And what they're thinking is that we're back here in the 2000s, where, of course, housing starts increased and rates went down. But most of the time, what you tend to see is a decline in yields, which is led by the bond market, indicates that financial conditions are getting tighter. And if people think monetary policy is tight now, wait till rates come down, because the banks are already not lending. What they need is rates to go higher to increase the spread that they can make money on when they lend. If rates go down, it tightens things even more. And what you can see is typically rates start to lead a decline in private housing starts. We see that here happening in kind of late 2000s. But right now, housing starts are headed down. If rates start to fall, it means financial conditions are getting even tighter. And for home builders, that's not the news they want at all. This, of course, is why Vanguard's making the case. The U.S. economy, we see it slowing down in multiple avenues: the housing market, the labor market, and now even in the construction market, as it declined in 3 regions, led by a whopping 19% slump in the Midwest. And while building activity picked up in the West, the pace is still slower than what it was seen for much of last year. And you start to look at housing starts and the labor market, and you see a very interesting correlation that as the housing market goes, well, what do you see? People hit the unemployment line. Is simply because the housing market employs so many people in different areas that is a critical part to the U.S. economy. Any further slowdown here means the manufacturing sector in the U.S. is all but a foregone conclusion that it's headed into a recession, and it means broadly that the U.S. economy is headed into one as well. And at the summertime, this is the worst possible news. So we come back to where we started the show with Vanguard's warning that if rates are indeed in vogue and bonds are going to be rallying here, well, it has bad news for the equity market, suggesting stocks more likely to head lower than higher. It also means the U.S. economy more likely to head into recession sooner than later. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.